debt. It can feel like a never-ending cycle of past due bills, high interest rates, and even collection calls. You want a way out, but most companies only deal with certain kinds of debt or offer quick fixes and even dangerous solutions that can destroy your credit and put you right back where you started. At Family Credit Management, we do things differently. First, we'll review your credit report to access who and what you owe. Then, we'll create a repayment plan that's in budget, lowers interest, and eliminates fees. We'll give you a roadmap out of debt once and for all by consolidating all your unsecured debt from all your creditors in our debt management program. You pay us once a month, and we work with your creditors to take care of the rest. For over 20 years, we've been helping clients get back on track to financial independence. Now it's your turn. Get your free quote today.
Hey, good evening. We are back for another week, and my name is Letitia Griffin, and I'm here to answer any questions that you may have regarding debt, regarding finances, any issues that you want or you need advice on. That's what we're here for. Now, I'm only here for a limited amount of time, so if you do not get the opportunity to call in, I want you to reach out to a counselor at Family Credit at 800-994-3328, and you can speak with a certified counselor and get the help that you need. So you can always feel free to do that because the counselors are on standby. Also, the website is listed there, familycredit.org, and I want you to take advantage of that because, like I said, if you're not in the mood to talk to anyone, you're not comfortable talking to anyone, or you're not able to talk to anyone, maybe you're at work and you just need a quick answer, you can go online to Family Credit's website and you can actually chat directly with a counselor and get the information that you need. Remember, there are resources out there available for your whatever your problems may be. So if you need that help, then this is a great place for you to turn to. So this week we've dealt with a lot of different clients that are trying to get things together, get things wrapped up because the year is winding up. And so everyone wants to make sure that their debts are in control, that they know what they're doing, that they're not going to be making resolutions or making plans so that they do not overdo it during the holiday season. And yes, the holiday season is now upon us. We've got Thanksgiving coming next week, and then after that, we're in full swing for Christmas. And right now also, this is the time of the year where people are finding it harder and harder and harder to address and talk about their finances, which is why we open up the conversation for your finances and for any types of situations or problems that you may have. So feel free to call us at 312-738-1060. Remember that you do want to get a handle on things because when your debts are out of control, when your finances are out of control, it does stress you out and it does take effect on your mental health as well as your physical health. So you want to make sure that you keep yourself together because we want overall financial fitness, right? That's what we strive for. It looks like we've got our first caller. Hi, welcome to the show.
Hi, how much of a down payment is required when getting a mortgage?
I'm sorry, I actually cannot hear you. Can you repeat the question?
Yes. How much of a down payment is required when getting a mortgage?
Oh, okay. So if you are looking for a mortgage, the perfect down payment that the banks want to see you put down is 20%. And that is a lot of money. It could seem like a lot of money. So that's actually the perfect payment that you want. But we know that that's not doable a lot of times. So let me give you an example. If you want to buy a $100,000 house, that means that the banks want you to put down $20,000 and they will finance the rest of it. But we do have a lot of options nowadays where if you do not have that much, then banks will require you put down anywhere between 3% and 5% at least. Now you can put down what you want, but you have to have at least 3 to 5%, and then you can qualify for a mortgage. Keep in mind that the more you put down, the better chances or the better rates you're probably going to get. And another key component of that is you want to make sure that your score is in order too, because the higher your score, the better your options will be. So there are two different types of mortgages typically that you deal with when you're looking at getting a home. You have an FHA or a conventional. And the conventional, of course, will require a little bit more down, and there are some different things that go along with it too, but FHA has made it easy for other people to get, for anybody to get a home that you feel that you can afford the monthly mortgage payment, and you just need to put a little bit lesser down. So with FHA, you can put down 3.5%. And sometimes with the conventional loan too, if everything is in order, if your finances are together, your score is in order, sometimes even with a conventional loan, they may allow you to put down 3% as well. But again, you want to make sure that you got the best options available. Perfect way to do that, start with your credit report, making sure that score is strong, making sure that your score is in order. When you're thinking about trying to get financing, be it a mortgage, be it a car, even just looking at other credit cards, the one thing that you want to do is make sure that your score is as high as possible for you. And it does not take a lot for you to get your score in order, because even though we've got the score that it changes so much with our situation, but really we want to keep in mind what we do now and how that affects our score as far as whether we're going to be seeking financing in the future as well. So if you're looking at trying to, again, thinking about your financial health, you want to get things in order, and you are thinking about buying a home next year, and if you're thinking about getting a new car, maybe around tax season, whatever you're thinking about doing, look at your score right now. So I want you to go out and pull your credit reports. And when you pull your report, remember there's 3 different credit bureaus that we typically tend to use. Now, does that mean that it's just 3 credit bureaus? No. But the ones that we use, the ones that are more important to us, and the ones that our scores are typically based on, TransUnion, Equifax, and Experian. So those are the 3 reports that you do need to pay attention to, monitor them closely, and make sure that your score is as high as you feel it possibly can be. And a lot of times we may get scared or say, hey, I don't know what my score is, or I just know it's bad. Something happened, I know it's bad, I don't even want to look. Now we need to get out of that mindset, and we all do it. Sometimes it's hard to face that reality of what our score actually is, but a lot of times what I tell people is that a lot of times your score isn't as bad as you think, and you do need to start somewhere, and you need to know what it is so that you can work on improving things. So the steps that you take today by looking at that score will put you in line a few months from now to be even better. So when we think about our credit scores, again, Equifax, TransUnion, and Experian, those scores range, and they have a numerical basis that ranges from 350 to 850, and you want to make sure that you're paying attention and have your scores humanly as high as possible. So if our scores range from like 3 to 850, and you pretty much just figure out what score you feel comfortable with to get the best offers. So if you're looking at getting a home, again, your score that you need to get a home typically starts at about 580. Anyone can get a home. Honestly, you can get a home at 500 too, but you are going to have to put more down. You have to prove that you have more money and you're stable. But typically, if you're looking to get a home, you need your score to be at least 580. If you can get your score at 620 or better, the better rates you will have available to you, the better financing you will have available to you as well. So those are some things that you want to think about. Now, we do know that we've got our credit report, which has our credit scores tied into it, but the report is separate from the score itself. So you do want to pay attention to the report and make sure that all the information that's reporting on it is accurate. And we'll talk about that in a little bit, but first, I do want you to reach out to a counselor if you've got some questions, and you can reach them at 800-994-3328. They are available. They can even help you with pulling your credit report and helping you go through it and figure out what's on it, who you need to address, if there's anything wrong, how to dispute it. So that information they can help you with. If you're struggling with it, feel free to reach out to them. Looks like we've got our next caller. Hi, welcome to the show.
Hi, I was wondering what the benefits are of refinancing my mortgage.
Okay. Well, if you are looking to or thinking about refinancing, you want to make sure that there is a benefit there, that there is a reason that you want to refinance. And typically when a person wants to refinance, they either want to get a lower interest rate, they want better terms, or they want to pull some money out of their home. And so those are a few different reasons why you would look at refinancing. Now, a lot of times when you go out and you get your mortgage, sometimes you may have to take a higher rate. Maybe your credit wasn't as good as you wanted it to be, but you needed to move, you were able to get the home, or even you notice that since you've gotten the home, rates have changed. Maybe rates are lower now. And so you want to see about making that rate better for you, because guess what? If you get a lower interest rate, you are able to get a lower payment. And that's what's called a net tangible benefit. You want to make sure that the reason for you refinancing is a benefit for you. Now, think about it. If you have a rate of maybe like 3% and you're going to refinance and they say that your rate's going to be 4%, is that really worth it? Is that a benefit? So that's why you do want to make sure that it works in your favor. So you want to check out whatever interest rate you can get, make sure that it's better than the one that you actually have. And also think about what your score is as well, because if your score is better than when you first got your home, then you're able to get a lower interest rate, and that's going to make things better for you too. Another thing that you want to think about is, do you have any other reasons maybe to pull money out of your home or to use the equity that's in your home? And you might say, okay, what's equity? What does that mean? And equity is just the value of your home versus what you actually owe on your home. So you want to make sure that you've got more money working for you. You want to make sure that you have that equity in your home, that if you owe $50,000 on your mortgage, but guess what? With the property values in your neighborhood, your home may be worth $200,000. That means that you've got $150,000 worth of equity that you can pull out of that home and turn it into liquid cash and make that work for you. So you may want to look into doing that, especially if you know you've got that equity that's saved up in your home and you are able to refinance. Now, sometimes people will do a refinance just so that they can fix up their home. There may be things that they want to fix up, maybe improvements that they want to make, adding on a deck, you know, expanding a room, those types of things. And those are also allowable when you're trying to do a refinance. You can renovate your home with the proceeds from that too. So there's a lot of different options, especially if you're thinking about your home, especially over the next few months, trying to make your money work for you, making sure that you're in a better financial position too. Also, if you refinance, you also want to make sure that you can afford the payment, and you want to see if you have your property taxes and you have your insurance escrowed, or that's where you're paying everything in one payment and the bank will divide it up and pay out your property taxes and pay out your homeowner's insurance for you in there, and you have that done, you want to make sure that when you refinance, they continue to do that too, because we have seen cases where some people refinanced and forgot to tell the lender that they wanted to do that. So those are some things that you want to watch out for. And again, if you need some help with that or you're thinking about anything like that, all financial questions can be answered by a certified counselor at 800-994-3328, or you can go online to the website. So if you've got any other questions about that, feel free to reach out. So we were talking about or delving into just looking at your overall financial health and making sure that your score is strong and that is healthy. And the reason for that is that you want to be able to get the best things in life. Again, we talked about getting good interest rates on a home loan. You want to be able to get a low interest rate when you go for a car. No one wants to get to the car dealership and they say, oh yes, we can finance you, but your interest rate is going to be 28% or 30%. You want those low interest rates too. So making sure that you know what's on your credit, that does help. And when you're looking at your score again, you want to start off with those 3 credit bureaus, pulling those reports and making sure the information that is on there is accurate and correct. Go through your credit reports, and sometimes they come, you get all this paper, you're looking at the report, it seems like it goes on forever and ever and ever, and you really don't know what you're looking at. But you want to make sure that you identify and look at a few key things. First, if you look at your credit report and you're looking at an account, the first account that's on there, you want to make sure that you write down the name of that creditor and look at what they say that the balance is, okay? That's very important. You also want to look at what your credit limit is. And I'll tell you about that in a minute, because those are some things that you want to pay attention to. You want to make sure that they don't show that you have any recent late payments. Your score looks at the last 24 months worth of history, even though your report has all this information that we're trying to go through, right? But you really just want to pay attention to what's happening now, what's happened within the last 2 years that's making that score what it is today. It looks like we've got another caller. Hi, welcome to the show.
Hi, what is the difference between a fixed rate and an adjustable rate mortgage?
Okay. Well, when you think about what a fixed rate, a lot of people aren't even sure when they get mortgages if they're getting a fixed rate or if they're getting an adjustable rate, so that is a really good question. So with a fixed rate, that means that whatever term your loan, and most people get a loan for 30 years. Now you can get a mortgage loan for 10, 15, 20, whatever term you select, but most people get a mortgage for 30 years. That means that if you have a fixed rate, your rate will stay the same over the next 30 years. Now, with an adjustable rate mortgage, your payments can change, and it is based on whatever the prime interest rate is. And what's going to happen is they will give you a term, and sometimes those terms will be like a 7-year or 10-year period, or sometimes they even have some that go 1 year or 3 years period. And what happens is at the end of that period, your interest rate will adjust. Now, a lot of times people will use an adjustable rate mortgage if they know that they're not going to stay in the home long. So if you get a 7-year, you know you're going to be moving within the next few years, so you get an adjustable rate that will adjust in 7 years, meaning that in 7 years that interest rate will reset itself, and whatever that rate is to that prime rate, it will add on additional fees and adjust additionally to increase or sometimes decrease the interest rate. It depends on whatever the market is doing, though. So that's why adjustable rate mortgages, sometimes people see them as kind of dangerous. You never know what's going to happen. You don't know what your interest rate is going to be, because that mortgage is going to reset every so often. And again, a lot of times if people know that they're not going to be in their home that long, then they'll do that. It makes sense to do an adjustable rate mortgage, because you may have a regular interest rate loan where you go to get a loan and the 3rd year will run you at about 4% interest. But then you look at doing an adjustable rate mortgage and they may tell you, hey, we can do an adjustable rate for 3.5 as compared to 4%, but we can only do it for maybe 7 or 10 years or however long they tell you it's going to be. And that loan's going to reset itself. The problem is, when it resets itself, you don't know what you're going to get. You don't know what the prime rate is going to be. So you are taking a risk on that. So some people will start off with an adjustable rate mortgage, and then what happens? Before it's time to adjust, they will refinance, just like our first caller called in with the question on the refinance. They can use that refinance to get out of that adjustable rate and then go into a fixed rate mortgage as well. So those are some really great questions, some things that you do want to think about, because you want to know what terms are out there. And again, you want to make sure that you get the best possible interest rate, the best possible terms for your lifestyle and what works with you. So for some people, they can do an adjustable and they can keep doing it. If they know they're going to be moving from house to house to house or city to city, then adjustable rates may work for them. If they know that they're going to refinance later on, or they know that they want to do some renovations, those are things that are out there and it works. They're there for a reason, so you can take advantage of it. Just make sure that you fully understand. You can talk to your loan officer about that. Make sure that they've explained those things to you, or even contact a counselor, Family Credit, 800-994-3328, to go over those financial decisions and choices that are out there to make sure that you have the best resources for you, and they're there for a reason. So we've been just talking about trying to make sure that our health, our financial health, is in good standing for next year, because those are things that we're going to be looking at, getting a home or getting a car. Also, when you're thinking about your insurance rates that are out there, that next year they may be your renewal period. Things are going to adjust, so you want to make sure that your score is in good standing too. So we've got a lot that we need to be thinking about. So let's talk again. We were talking about the score and how those things affect us. And we want to make sure that you understand the ins and outs of your score so that you can get that help that you need. But first, we've got another caller. Hi, welcome to the show.
Well, hello. I'm going to be starting the process of getting a house soon. How will mortgage lenders determine what my interest rate will be?
Ooh, that's a really good question. Now, if you are thinking about getting your house again, like we said, the best thing for you to do is look at your score first. But that's not the only thing that the lenders will look at as well. So if you are looking to get a home, you want to make sure that your score is in good standing and as high as possible with no late payments. That's the perfect scenario, perfect situation. Also, you want to make sure that you can verify that you have been working for at least the last 2 years consistently. You need steady job history, and you do have to prove that. Now, if you're self-employed, then you need to be able to prove that you have consistent income, and you've had it for the last 2 years as well. So you just want to be able to verify that. You will need to show your paycheck stubs, your W-2s. You might even have to pull out those tax returns. Especially if you are self-employed, you will have to pull out those tax returns. Another thing that you want to think about is making sure, and this is so very important if you're trying to get a home, you need to make sure that you are in good standing with the IRS. If you have IRS debt, you do want to address it. If you have not filed your taxes, you need to do that. These are some things, because you have to think about it. You are asking for a loan, and you're going to government entities, you're going to different banks, you're going to financial institutions where they're heavily regulated. They need to make sure that all the information that you give them is accurate. So of course, they are going to go to the IRS, to the government, to make sure that you're in good standing. And also student loans, you want to make sure those are in good standing. If you've got income-based repayment plans, know what those payments are. And if you're not, you want to make sure that you're making your actual student loan payments as well, because we can't go to the government and say, hey, you need to give this person a home if you are not in good standing with the IRS. So you want to keep that in mind too. So that's very important. So you want to make sure you've got your credit in good standing, at least a 580 score. If you can do better, the better for you. And the counselors can help you get there. So feel free to call and reach out about that. You want to make sure that you can verify your income, that you've got a consistent job history, and you want to make sure that your IRS debt is taken care of. And the last missing key to that, you want to make sure that you can afford to get the house as well. You need to save, budget, putting a budget together, being able to have a savings or just have enough for a down payment. That should be your goal. So those 4 things do play into each other. Now, that's not all you need to do though, but that's a great place to start. Now, when you think about how much should you be saving for a down payment or for a home or even for anything that you're trying to do, you want to save as much as possible, right? But it's always good to know an amount. Remember, we talked about how much you needed to have for the FHA loans and for the conventional loans, anywhere between 3 and 5% of the purchase price. So if you're going to get a house for $100,000, that means that you need to have at least $3,000 or more in the bank so that you can get that house. And you want to make sure that you have that and can prove that that money has been seasoned or sitting in the bank for at least a couple of months. So that's very important too. You can't just say, okay, I'm going to go buy a home, let me throw this money in the bank and then I'll go get a home right now. It doesn't work like that. You have to be able to prove that you are responsible, that you can be that you are a good risk to take for the banks, that you are able to make the payments, and that you've got the money to afford it. So you do have to let it sit there and become what's called seasoned. That money needs to sit there and become seasoned. And how long does that take? About 2 months. So it's not that long, but anytime you put a lot of cash in the bank and you're trying to get a house, you have to go through hoops and explain where it came from and how you got it. So it's just the same to just put it in the bank now, work on getting your credit together, let it sit there, and make sure everything gets better. We'll be back next week. If you've got any other questions, again, you can reach out to a counselor, 800-994-3328. Ask any questions that you may have during that time, because your financial health is important and there are resources to help you. So reach out, get the help you need, and we will see you next week. Take care.